Good evening, everyone. In today's presentation, I'll be discussing the key international financial reporting standards and the IASB framework. These standards are essential for ensuring companies' consistency and transparency in financial reporting across the globe. I'll be covering topics such as the IASB framework, impairment of assets under IAS 36, the non-current assets held for sale under IFRS 5, the foreign exchange impacts under IAS 21, the revenue recognition under IFRS 15, and at last the lease accounting under IFRS 16. Throughout this presentation, I will explain each standard, provide examples, and discuss how they can affect the company's financial statements. Let's get to the main point of the first slide, which is the IASB. The International Accounting Standard Board is an independent body responsible for developing and establishing high-quality, globally accepted accounting standards. The IASB's mission is to create a set of standards known as the IFRS that brings transparency, accountability, and efficiency to the financial markets around the world. Well, this comes with both benefits and the disadvantages. Let's get to the first main subpoint, which is the benefits. The IASB framework promotes consistency, transparency, and comparability in financial reporting by ensuring that organizations worldwide adhere to the same accounting rules, which means the companies all around the world has one set of rules, which is decided by the IASB. The consistency allows investors and stakeholders to easily compare the financial statements and across companies, regions, and worldwide locations. Increased transparency through detailed disclosures reduced the risk of fraud and misinterpretation, provide a clear insight into the company's financial statements. Well, it also comes with the disadvantages too. Transitioning to IFRS requires significant investment in training, system upgrades, and possibly external consulting. Additionally, the complexity of the standards can make them very difficult to apply correctly, especially for companies with specialized needs. Moreover, fair value accounting, a core component of IFRS, can introduce volatility in financial results, leading to unpredictable financial statements. The IASB framework consists of various accounting standards, and IAS 36, the impairment of assets, is one of them. IAS 36, the impairment of asset, ensures that an entity's assets are not valued higher than their recoverable amount, defined as the greater of fair value minus the selling cost and the value in use. If an asset's carrying in amount is higher than its recoverable amount, it is impaired and an impairment loss is recorded, which can be more clearly understood by the example which is provided in the slide. As it says, a company owns a piece of machinery which originally cost around $500,000. As the market goes, it comes in a downturn in the market, and the machinery's productivity and the profitability has decreased, and the company now estimates that the machine's recoverable amount is only $300,000. Initial measurement is recorded when the machinery was first purchased. It was recorded at its purchasing price of $500,000. This represents the asset's cost when it first entered the company's financial statements. In subsequent measures, after the market value downturn, the company re-evaluates the asset's value. So due to IAS 36, they recognize its recoverable amount is now only $300,000. This requires a subsequent measure adjustment, reducing the asset's carrying value. And now to the last point, which is the machinery was recognized in the company's balance sheet as an asset at its full purchase price of $500,000, reflecting its value and future economic benefits to the company. Let's discuss the next accounting standard of IASB framework, the IFRS 5, non-current asset held for sale and discontinued operation. The IFRS 5 can be defined as an accounting standard for reporting non-current assets that are held for sale and discontinued operation. For assets a company plans to sell, the IFRS 5 requires them to be valued at the lower cost of the book value or fair value minus the selling cost. While classified as for held for the sale, these assets are not just depreciated and are also shown separately on the financial statements. Let's get to the example which is mentioned over here in IFRS 5. A company decided to sell one of its business divisions that produce electronic parts. And this division mainly includes the machinery, the equipment, and the inventory that the company no longer planned to use it, as it shift focus on different products. And the company expect to complete the sale within 1 year. Let's get to the first point, which is the initial measurement, where the company first acquired the business division's asset. Example like the machinery, the equipment, and they were measured at their purchase cost and depreciated over time. As a subsequent measurement, the assets are remeasured as held for sale at the lower of their carrying amount, let us say a £2 million, or fair value less cost to the sell, which is around £1.8 million. This downward adjustment reflects the division's lower recoverable value. The division's assets were recognized as part of the company's property, plant, and equipment on the balance sheet. Whereas come to the de-recognition, once the sale is completed, the assets are fully de-recognized from the company's balance sheet, and any resulting gain or loss on sale is recognized in the income statement under discontinued operations. Let's discuss the next IASB framework, which is the IAS 21, and that mainly focuses on the effects of changes in foreign exchange rates. IAS 21 provides the rules for handling transactions in foreign currencies. It mainly guides how to record the foreign currency transactions, translate the financial statement of foreign operation, and report the exchange's rate difference. Let's get into more clear understanding by discussing the example. In here, a UK-based company made a sale with a US company for $100,000. The invoice is due in 30 days and the payment will be made in USD. But when the purchase is recorded, the exchange rate was 1.25 USD for £1, and that calculates around 80,000 pounds. In initial measurement, the inventory is recognized at 80,000 pounds, which is of the rate of 1.25 US dollars. But as the date approaches, the exchange rate has changed for £1, which is equal to the 1.20 US dollars. And that increases the value of GBP to roughly around 83,333, and which is also an extra amount that the UK company needs to pay. On the purchase date, the inventory is recognized in the company's financial statement at roughly around 80,000 pounds. But once the payment is made, the liability is de-recognized from the balance sheet. Any gain or loss due to the change in exchange rate, which is roughly around 3,333, is recognized as recognized in the income statement. Let us discuss the next accounting standard of IASB, which is the IFRS 15. And that mainly focuses on the revenue from contracts with the customers. This provides a framework of recognizing revenue from customer contracts. It requires entities to recognize the revenue when they transfer goods or services to customers at an amount reflecting the expected payment. Let's get into a more clear version by discussing an example. In here, a software company signs a deal with the client to deliver a software license for 12 months of technical support, and the total contract price is around £12,000. In the initial measurement, the payment made is £12,000, which comprises of both the delivery for software license and also for the technical support. In subsequent measurement, the revenue is recognized over time as each performance obligation is performed. The license amount is recognized immediately at around $10,000 when delivered, and the support services, which is split at around 12 months, that's roughly around $167 for the 12 months, and that comprises to amount of $2,000. The corresponding portion of the contract revenue is re-recognized from the liability and recognized as revenue in the income statement. Now, let us discuss the last topic in the slide, which is the IFRS 16 leases. The IFRS 16 requires the leaseholders to recognize the most leases on the balance sheet as assets and liabilities, reflecting the right to use the leased asset and the obligation to make the less payment. This mainly improves the transparency in lease accounting. Let's discuss an example of IFRS 16, which is a company of XYZ Limited enters into a 3-year lease agreement to rent the office space, and the lease payments are $5,000 per month, with a total of 36 payments to be made over the lease term, and this represents a whole value of around 170,000 after using an appropriate discount rate. In here, the initial recognition says that the right of use of asset is at $170,000, representing the right to use the asset office space for 3 years. And the lease liability of $170,000 represents the obligation to make the lease payment over the whole 3 years. In subsequent measures, the right of use asset is depreciated at around $56,667,000 per year for 3 years. And whereas it comes to the lease liability, it's reduced as monthly payment of $5,000 are made. The interest expense is also recognized on the lease liability based on the discount rate applied. At the start of the lease, both the companies recognizes both the assets and liabilities at the present value of the future lease payment. At the end of 3 years, the ROU asset and the lease liability are both de-recognized from the balance sheet, and the company is no longer able to use the office space for 3 years or no longer have the ability to pay the lease. These are some of the sources which I have referred in order to complete this PowerPoint presentation. Thank you everyone. Have a wonderful evening.